Welcome to the deep dive. Today, we're really digging into Amazon's Q1 2025 earnings.
Yep, lots to unpack here. We've sifted through the official releases, the earnings call transcript, all that financial news analysis.
Right, and the goal is to cut through the noise, figure out what's really driving things, and what the future might hold for AMZN.
Exactly. We're trying to pull out the most important pieces for you.
So we'll walk through it, sort of chapter by chapter, starting with the big picture, then results, drivers, the outlook.
And finish up with the key takeaways.
And hey, before we jump in, if you like this kind of analysis, make sure you subscribe to the Stock Analytics AI YouTube channel. Lots more insights there.
Good point. And remember, the usual disclaimers apply. This is financial info, AI discussion. Treat it as such.
Okay, let's do it. Chapter 1, Executive Snapshot.
Chapter 1, Executive Snapshot.
So the big headline right away. Amazon beat expectations. Revenue and earnings per share for Q1.
Yeah, they came in above what most analysts were predicting. Signals pretty solid operational execution, wouldn't you say?
Definitely. And the summary pointed to a few key things driving that.
Right. AWS growth accelerating. Then that's a big high-margin cloud business. North American e-commerce was surprisingly resilient.
Okay.
The international segment seems to be improving too. And advertising just keeps growing strongly.
And it wasn't just revenue, right? Operating income, net income, those saw big jumps too.
Huge jumps year over year. That operating leverage they talk about, plus the efficiency work, it seems to be paying off on the bottom line.
Spreading those fixed costs over more sales makes sense.
Precisely. Those cost-cutting and streamlining efforts, they're showing up in the profit numbers now. Good sign.
Okay, but it wasn't all positive, was it? There was this mention of free cash flow.
Ah, yes.
Yeah.
The trailing 12-month free cash flow, that actually saw a notable decline.
And why is that important?
Well, it's mostly down to massive capital expenditures. They're spending a ton on AWS infrastructure and building out their AI capabilities.
So heavy investment, pouring money back into the business, specifically those growth areas.
Exactly. It's a strategic choice. Invest heavily now for the long term, even if it means less free cash flow today.
Gotcha. And what about external factors? Management mentioned tariffs.
Yeah, potential tariffs.
Yeah.
That introduces uncertainty,
Yeah.
especially for their retail side, cost of goods, inventory management.
Could squeeze margins there.
It could. They even mentioned some costs they already incurred in Q1, kind of bracing for that possibility.
Interesting. So strong numbers, but this investment and tariff uncertainty maybe explains the market reaction. It seemed a bit mixed.
I think so. The Q1 beat was good, obviously.
Yeah.
But the market looks ahead, right?
Right.
So the lower FCF because of spending, plus the tariff talk, probably made some investors take a pause, weighing the good now against future risks.
Okay. And their guidance for Q2, what did that look like?
Revenue guidance for Q2 was actually pretty solid. Midpoint slightly above where consensus was before the report, but the operating income guidance had a really wide range.
Signaling what? More investment? Uncertainty?
Probably both. Reflects those ongoing big spends on AI and AWS, and maybe hedges against those external factors, like consumer spending or those tariffs.
So wrapping up the snapshot, strong quarter, but the big question is, can they manage these huge investments and navigate the uncertainties to keep delivering?
That's the core tension, yeah. Which brings us nicely to Chapter 2, digging into those actual results versus what was expected.
Chapter 2, results versus expectations. Okay, let's put some numbers on that beat. Net sales were $155.7 billion. How much better was that?
Well, consensus estimates were mostly in the $154.6 billion to $155.3 billion range. So $155.7 billion is a beat of about, say, 0.3% to 0.7%. Not huge, but positive.
Okay. And year-over-year growth?
Reported growth was 9% compared to Q1 last year.
But there was a currency impact, right?
There was. About $1.4 billion unfavorable FX impact. If you adjust for that, the underlying growth was actually 10% stronger.
Always important to look at that constant currency number. Sequentially, though, down from Q4.
Oh, yeah, definitely. Revenue down 17.1% from Q4 2024. But that's totally normal post-holiday seasonality for them. Expected.
Right. Q4 is always the monster quarter. Okay, bottom line, EPS. $1.59. That beat seemed much bigger.
It really was. Consensus was looking for maybe $1.35 to $1.37. So $1.59 is a, 16% to almost 18% beat? That's significant.
Wow. And compared to last year's Q1?
Even more impressive. Q1 2024 EPS was 98 cents. So getting to $1.59 this year. That's a 62% jump year over year.
62%. That really points to improved profitability.
Absolutely. Fundamental improvement there.
And like revenue, EPS was down sequentially from Q4.
Yep, down 14.5% from $1.86 in Q4.
Yeah.
Again, normal seasonality, bit less operating leverage after the holiday peak.
So Chapter 2 summary. Beat on revenue, but a much bigger beat on profitability on EPS.
Exactly. That magnitude of the EPS beat is the real story here. It screams successful cost management, operational efficiencies kicking in.
Especially in those higher margin areas like AWS and ads.
You got it. And those strong year-over-year growth numbers, especially that 62% EPS jump, really suggest the underlying business fundamentals are moving in the right direction.
Okay, makes sense. Let's move to Chapter 3, drivers and management highlights. Why did they perform so well, and what did management emphasize?
Chapter 3, drivers and management highlights. Okay, so the tone from management, very positive, very confident.
What were the main themes?
Lots of talk about innovation, especially AI, big focus on customer experience, continued push on operational efficiency, AWS strength, obviously, and that advertising momentum just keeps rolling.
AI seemed like a huge focus.
Yeah.
They're not just testing the waters anymore.
Not at all. Jassy explicitly said they're not dabbling. They talked up Alexa plus new AWS AI services like Bedrock, their Trainium 2 chips,
Right.
and how they're weaving AI into everything, fulfillment, ads, Prime Video. It's clearly foundational for them now.
And the customer experience part, what did they highlight there?
It's mostly delivery speed, record Prime delivery speeds globally, more same-day and next-day deliveries than ever, showing those logistics investments are working.
Makes sense. And operational efficiency. Still hammering away at that.
Oh, yeah. Still talking about regionalizing fulfillment, fixing inbound logistics, cutting costs to serve. They even mentioned better safety metrics as part of that.
Okay. And AWS, still the powerhouse.
Absolutely. They hit a $117 billion annualized revenue run rate. Massive number.
Bro.
And they see AI as a huge long-term opportunity for AWS. Plus, they still think there's tons of room for basic cloud migration.
And advertising, still growing fast.
19% year-over-year growth. Management definitely sees it as a very profitable key part of the business now.
So putting it together, what did they credit for the strong Q1?
It was a mix. Strong AWS growth and profitability, both core cloud and the new AI stuff. High margin advertising, obviously.
Yep.
Resilient North American e-commerce, helped by those efficiency gains.
Yeah.
The international segment improving, especially on an FX neutral basis. And yeah, those fulfillment optimizations underpinning a lot of it.
But they must have acknowledged some challenges too. It can't all be smooth sailing.
No, they were pretty open. Mentioned the $1.4 billion FX headwind again. The uncertainty around tariffs, which makes inventory planning tricky.
Right.
Intense competition across the board, cloud, retail, ads, the increased CapEx hitting free cash flow. We talked about that.
Yeah.
And even potential capacity constraints for AWS AI services if demand grows too fast.
Interesting. So the narrative seems to be, we made ourselves more efficient. Now we're using that strength to fund the next big thing, which is AI and AWS expansion.
That's exactly it. They're justifying the heavy spending and the SEF pressure as necessary for long-term leadership and value creation, using past gains to fuel future growth.
And they gave some specifics on one-time charges, too. That helps understand the underlying margins.
Yeah, they did. Quantified the hit from things like historical customer returns and those tariff-related inventory costs. Said it lowered North America operating margin by about 90 basis points, international by about 70.
Okay, so that transparency is good. It gives a clearer view of the core profitability trend.
Exactly. Helps you see the real operational performance underneath those temporary items.
Right, that paints a good picture of the drivers. Let's shift to Chapter 4, Outlook and Key Metrics. What are they expecting next, and what do the detailed numbers tell us?
Chapter 4. Outlook and key metrics. So first, the guidance for Q2 2025. For net sales, they're guiding to a range of $159.0 billion to $164.0 billion.
Which implies?
Continued growth. That's about 7% to 11% year-over-year growth expected. They see a small FX headwind again, maybe 10 basis points.
And how does that compare to expectations?
The midpoint of that range was actually a bit higher than the pre-earnings consensus, so solid top-line outlook.
Okay, but what about operating income for Q2?
That's where it gets interesting. The range is much wider. $13.0 billion to $17.5 billion.
Wow, that's a $4.5 billion spread compared to last year.
Q2 2024 was $14.7 billion.
Yeah.
So the midpoint of this new guidance is only slightly higher. Modest YoY growth at the midpoint, but yeah, that wide range.
Suggests uncertainty.
Big time. Reflects the ongoing heavy investments, AI, AWS build-out, plus maybe caution around consumer demand, tariffs, etc.
And their guidance assumes no major M&A or legal stuff, right?
Correct. Standard assumption they usually include.
So the takeaway on guidance. Solid sales momentum continues, but profitability is less certain in the near term due to investments and risks.
That sums it up well. The top line looks good, but the bottom line has more question marks attached for Q2.
Which probably feeds back into that cautious market reaction we discussed.
I think so. Even with the Q1 beat and decent Q2 revenue guide, that wide OI range, plus management talking openly about CapEx hitting FCF and tariff risks, it likely reset expectations a bit lower for near-term profit growth.
Okay, let's break down the Q1 performance by segment. North America.
North America did $92.9 billion in revenue. That's up 8% year over year, and it beat consensus slightly.
And profit.
Operating income was $5.8 billion, up from $5.0 billion last year. Margin was 6.3%, but remember those one-time charges. Adjusted, it was closer to 7.2%.
Okay, driven by steady e-commerce, ads, and efficiencies.
Exactly. Ads are a big high-margin contributor within North America now, plus the fulfillment improvements helped.
How about international? Always a bit tougher.
Revenue was $33.5 billion, up 5% reported, but FX neutral, it was up 8%, which also beat consensus.
And profitability there.
Operating income improved slightly to $1.0 billion from $0.9 billion. Margin was 3.0% reported, maybe closer to 3.7% adjusted. So signs of better operational performance, but FX is still a drag on the reported numbers.
Got it. Now the big one, AWS.
AWS revenue, $29.3 billion. That's up a strong 17% year over year.
Which was in line with expectations and faster than Q4.
Yeah, pretty much in line. Maybe a hair light for some very bullish estimates, but crucially, it accelerated from Q4's growth rate. That's positive.
And the profitability.
Phenomenal. Operating income hit $11.5 billion, way up from $9.4 billion last year. And the operating margin was a record, around 39.3%.
Wow, almost 40% margin. Still the profit engine.
Absolutely, and that puts them at the $117 billion annualized run rate. Just huge scale.
But how does that 17% growth stack up against competitors like Microsoft Azure or Google Cloud?
That's the key context. It's strong growth, but it did lag. Azure was growing, 35%? Google Cloud at 28%.
And Azure specifically called out AI driving their growth.
Exactly. It highlights just how fierce the competition is, especially in AI where everyone's scrambling. AWS is huge, but others are growing faster right now, particularly citing AI.
Okay. And the advertising segment.
Ads revenue came in at $13.9 billion. That's up 19% year over year, also beat consensus.
What's driving that?
Sponsored products are still key, better ad relevance, and they're expanding into things like Prime Video ads, more full funnel options.
And how did that 19% compare to, say, Google or Meta?
It significantly outperformed Google's ad growth in the same period, which was more like 8.5%. And it was strong relative to Meta's 16% growth, too.
Yes.
So advertising continues to be a real standout.
Okay, let's look deeper at some specific KPIs. Anything else jump out?
Well, we hit the AWS 117B run rate. The delivery speed metrics, fastest ever, Prime, record same-day, next-day volumes show those fulfillment investments are tangible.
Right.
Third-party seller mix was stable at 61%. Shows the marketplace remains critical. Ad metrics mentioning over 275 million ad-supported viewers in the U.S. just highlights the scale there.
Yeah, massive reach.
And the really new, interesting one, quantifying the AI business, even vaguely, calling it a multi-billion-dollar annual run rate with triple-digit growth, mostly from AWS. That's the first time they really put a size on it.
Multi-billion-dollar run rate for AI already.
Okay.
And headcount.
1.56 million employees.
Yeah.
Slightly below some estimates, which might hint at some productivity gains alongside the growth.
Interesting. Okay, overall financial health check, margins, cash flow, balance sheet.
Profitability metrics looked great in Q1. Gross margin up significantly to around 50.5%.
Nice.
Operating margin strong at 11.8%, even better adjusted. Net margin also healthy at 11.0%. Big improvements year over year.
Good momentum there. Cash flow.
Operating cash flow, OCF, on a trailing 12-month basis is still strong, up 15% year over year to $113.9 billion. Q1 itself was $17.0 billion.
But the CapEx.
That's the story. TTM CapEx nearly doubled year over year to $88 billion. Q1 alone was $25 billion, mostly for AWS and AI.
And the impact on free cash flow, FCF.
Significant decrease. TTM FCF down 48% to $25.9 billion. And Q1 FCF was actually negative $8.0 billion because of that heavy spend.
Negative FCF in the quarter. Wow.
Yeah. So strong OCF, but it's being plowed right back into CapEx, leading to weak or negative FCF right now. That's the trade-off.
And the balance sheet, still solid.
Looks solid. Lots of cash, over $66 billion. Debt to equity is moderate at 0.54. Leverage seems manageable. Altman Z-score is strong at 5.35, suggesting low bankruptcy risk.
So the financial picture is improving margins, providing cash, but that cash is immediately reinvested into massive AI/AWS buildouts, crushing near-term FCF.
That's the narrative in a nutshell. Investors are watching that CapEx spend very closely, looking for the future returns.
Okay, we've covered a ton. Let's bring it home. Chapter 5. Bottom line takeaways. What should listeners really take away from all this?
Chapter 5. Bottom line takeaways.
Sure.
Key points. 1. Strong Q1 overall. Beat expectations, showed solid execution.
Okay.
2. AWS is reaccelerating growth and hitting record profitability. Still the core profit engine, fueled by cloud and AI demand.
Got it.
3. Advertising is a powerful contributor. High growth, high margin, outperforming some peers.
Yeah.
4. AI is the big future bet, but it comes with massive upfront costs that are hitting free cash flow hard right now. Need to watch ROI there.
Critical point.
5. Fulfillment efficiencies are real. They're improving delivery, helping customers, maybe freeing up investment capacity.
Makes sense.
6. The outlook is cautious despite solid Q2 revenue guidance. That wide operating income range signals investment pain and external uncertainties like tariffs.
Right, the uncertainty factor.
7. Competition is intense everywhere. AWS growth lagging Azure GCP, especially on the AI front, is something to watch. E-com and ads also very competitive.
It's true.
8. It's all about balancing opportunities, AI, cloud, ads against risks, tariffs, competition, macro factors, and just executing on these huge investments.
So for investors, it's like great current results, but overshadowed a bit by the sheer scale of the AI gamble, the FCF impact, and near-term economic questions.
I think that captures the investor perspective well. They'll be laser focused on AWS's AI competitiveness and whether these massive investments pay off long term.
Yeah, that seems to be the crux of it, balancing today's strength with tomorrow's big, expensive bets.
Exactly. The market seems to be doing that calculus right now. Strong foundation, but the path forward involves navigating some significant spending and competitive challenges.
Okay, well, that wraps up our deep dive into Amazon's Q1 2025 earnings. Definitely a strong quarter operationally, but clear signals about massive future investment.
So the key message for you, our listener: Amazon had a solid Q1, AWS and ads looking good, but that huge AI investment, it's seriously impacting cash flow now and creates some near-term fuzziness, even with decent revenue expected. Long-term, it all comes down to whether those AI bets pay off and if they can stay ahead in a super competitive tech world.
And maybe a final thought to leave you with. Considering just how much Amazon is pouring into AI and how competitive it is, what kind of unexpected ripple effects could we see across the economy or in totally different industries as this tech gets built out and used at scale? Something to think about.
Definitely food for thought.
Thanks for joining us on this deep dive. If you found this helpful, please do subscribe to the Stock Analytics AI YouTube channel for more analysis like this one.
And just a reminder, all the usual financial and AI disclaimers apply to our discussion today.
We'll catch you on the next deep dive.